Welcome everyone. Today's video will be a compilation of the first 5 advanced trading strategies videos that I've posted on my channel, and hopefully you can find some value in them. Now, each of these trading strategies will offer different risk reward profiles compared to the simple going long or going short, Bitcoin, ETH, Dogecoin, that sort of thing, right? A lot of these strategies are easy to actually implement once you understand them, and some will be difficult to implement, and I'll go over some of the risks and why you might not want to implement them, as well as why you might actually want to implement them, because like right now we're in a bear market and you have to find different ways in order to make money. And as I said before, like the one I offer today, which is basis trading, it offers a different risk reward profile, which might be very interesting to some people out there. And it's actually quite an easy strategy to implement once you understand it. It's pretty much set and forget. And for some people, it's going to be worth it, others not. So use this video as a starting point and do your own research if you wish to go any further. So to explain basis trading, I need to go into perpetual futures. So if you already know what this is, you can skip ahead forward. But if you're not familiar with perpetual futures, they are derivatives that derive their value from the price of an underlying asset. So for example, an Ethereum perpetual future will closely follow the price of spot Ethereum. Now, people will use perpetual futures because it allows them to leverage trade when it might be harder to leverage trade spot Ethereum. Like a lot of places don't offer it, or you have to have a certain sort of like KYC level, and so a lot of people will trade perpetual futures. So just to go on further, we'll speak about funding rates. Now, funding rates are a key part of perpetual futures. So funding rates help incentivize the price of a perpetual future to follow the price of an underlying asset. So if the price of the perpetual future is above the spot price, you'll have what's known as a positive funding rate. And when that occurs, people who are long the perpetual future must pay a portion of their position to people who are short. So in this example, let's say the hourly funding rate is 0.009% and you have a 100k long position on an ETH perp. Well, then every hour you'd pay 90 cents, and that 90 cents would go to someone who's short the Ethereum perpetual future. Now, if the opposite happens and the perpetual futures price is below the spot price, then you have what's known as a negative funding rate, and people who are short must pay a portion of their position to people who are long. So funding rates help keep the price of the perpetual future to follow the price of the underlying asset. Now, this is because one, it can become too expensive to be in a trade. So we just saw, for an example here, that the hourly funding rate was 0.009%. Now imagine it was 0.12% and you were long 100k. Well, then every hour you'd have to pay $120. And at this point you might be like, right, it's actually not worth it for me to be long this perpetual future right now. I might as well just close out my position and just go long the spot asset instead of going long the perpetual future, because look how much you're paying. So you'd close out your position, and then that would help push the price of the perpetual future back to where the spot price is. And then the second reason is that it encourages basis traders to come in and bring prices back to normal, because you can take advantage of these funding rates to generate a high yield delta neutral position. So to explain it, I'll just set up a scenario for you here. So imagine the perpetual futures price of Ethereum is $3,917 and the spot price of Ethereum is $3,914. Now we can assume that there is a funding rate of 0.00783% per hour, and this comes out to a annualized funding rate of 68%. Now I'll just cut to a video I previously made on this channel just explaining what's happening here and how you can profit from it. Just to show you here what I'm talking about. What happens is you're shorting $400 worth of ETH perpetual futures, and then you're long $400 worth of ETH spot. And that effectively gives you 0 ETH exposure. So in your portfolio, you will have 0 exposure to ETH, but the total value should still be $800 no matter where the price of ETH goes. ETH could go up, down, sideways. It doesn't really matter, because your long and your short position balance each other out, and then your $800 should hopefully stay a stable $800. So the value of your portfolio would be $800 plus whatever yield that you're generating here. So the funding APR is 69.5%, but we're using $800 and $400 will be on drift. The other $400 will be off of drift in a spot ETH position. So the actual yield that you're receiving is going to be 35% roughly. So you're generating 35% APR on stablecoins is effectively what you're doing. The trade that you've created is a synthetic stablecoin. To start executing this trade, what you're going to need to do is go to Drift and then deposit USDC. I've already done that. I've got 400 USDC in Drift right now. And we're going to go to sell because we're going to be short selling the Ethereum perpetual futures. Let's just do $400. Okay, so let's do this now. Let's press sell. And then this is just the confirmation of the order. Okay, so my position's been opened up and my entry price is at 3,921. I'm going to quickly go to Jupiter Aggregator and then buy some ETH. So I'm going to press swap here. And hopefully I should be getting a similar price. 0.102, 0.10199. So I think I bought it slightly cheaper here on Jupiter Aggregator, which is just fine with me. And so there we go. It was easy as that to set up your delta neutral trading position. And to unwind it, all you'd need to do is close this short position. So you could do it like this. Press close 100% of the position and then confirm it in your wallet. And then go ahead and sell the ETH that you have here as well. So that's how the trade is done. Now I wanted to show you an article here, basically from Lima Finance, and they talk about basis trading and some of the benefits of it, as well as going through a back test that they did. They did a basis trading back test on Bitcoin, and as you can see here, we have the Bitcoin price in red, and then we have the basis trading position value in blue. As you can see here, it's underperformed Bitcoin over time, but it's done pretty well in the sense that you've made money, and I think you even outperform the general S&P 500 stock market. So you beat a lot of investors by doing this strategy, and you're not taking very much risk when you think about it in terms of price risk, right? Basically, you're just collecting funding over time, and eventually, and usually that goes up because people are perma bullish crypto, especially in bull markets. People will take on tremendous leverage in order to go long because, you know, you can make a lot of money for doing so. So you can see here, you know, they made the chart and they give a description of it. Holding Bitcoin performed better, but basis trading had nearly 90% less of a drawdown, which is the decline from historical peak compared to Bitcoin. Both strategies had strong USD denominated returns. So in the past year, 19th of May 2020 to 19th of May 2021, basis trading resulted in a 103% return with a max drawdown of 0.3%, whereas holding BTC resulted in a 297% return with a max drawdown of 40%. So for some people, this will be attractive. You haven't made as much, but the drawdown has been very minimal. And so that you know that your money is just slowly going up over time. I mean, that was in the midst of a bull market. Of course, as you can see here, you've had down periods, especially in 2018 when there was a bear market and the perpetual futures price was way below the spot price. And at that point, if you're still shorting the perpetual future, you're having to pay a funding rate for doing so. But if you just kept holding on, eventually you made money over time. But this isn't specifically what I wanted to talk about. I wanted to talk about the leverage strategy, which looks way more appealing. So as you can see here, you perform way better if you're using 2x leverage to perform this strategy. So the 1x leverage strategy is, I'll just give you an example here. Say you have $100, $50 of it is Bitcoin and $50 of it is USD. So you hold the $50 of Bitcoin and then you short $50 worth of Bitcoin perpetual futures contracts. And that's your 1x leverage strategy. But your 2x leverage strategy would be to hold entirely Bitcoin. So you'd hold $100 worth of Bitcoin and then short $100 worth of Bitcoin perpetual futures contracts as well. As you can see here, it's outperformed Bitcoin since the start here, which is in early 2016. Now this backtest ended in May of 2021, but if we go to this funding rate aggregator website here, we can see that generally, most crypto markets out there are generally just bullish over time. If we see here all time, we can see that the funding rate is generally above zero. I mean, there are some markets where it's not, where it is negative. I mean, this is just on Binance. There are other markets that you can do this on as well. But we can see here people are just generally bullish on the price of crypto. And it's not only just Bitcoin and Ethereum. It's like Bitcoin Cash and XRP and EOS and Litecoin, which is funny to me. But if we just click on this graph here, we can see that generally the Bitcoin USDT funding rate is positive. Zero is this like line here. We can see it's generally positive. We've had, a month or two where it's been negative. So in like late 2019, early of 2020, January 2021, and then quite recently here in November of 2022 as well. But we can see people are generally bullish, and that leads me to believe that the 2x leverage basis trading strategy would have continued to outperform Bitcoin since the end of this backtest in May of 2021. And I don't think it would have had much of a drawdown as well. Pretty much you can execute the 1x leverage basis trading strategy anywhere. So, like Binance, Kraken, Coinbase, pretty much any perpetual futures DEX out there. But there's only going to be a few places where you'll be able to execute the 2x leverage basis trading strategy. So again, a lot of these centralized exchanges will probably let you do it. Like Binance, for example, you can use Bitcoin or Ethereum as collateral. Same as with BitMEX as well. But in terms of DeFi, not that many places actually allow you to use exotic collateral. Most perpetual futures dexes will use like USDC or DAI as their base collateral there. One exception of this is Drift. So you can actually use Solana as collateral here. So you could obviously execute this strategy on Sol markets. And I believe Mango Markets offers you the chance to do this as well. So there definitely are risks to executing this strategy. So just generally, if you're doing it on a DEX, for example, you have smart contract and user interface risk, blockchain risk, Oracle risk, liquidation risk. And some of these risks also exist on centralized platforms as well. So don't think it's just DEXs that you might have a problem doing this on. And so just generally as well, if the funding rate goes against you for quite a while, this could eat into your profits. So as we've seen here, it went against you in early 2018. And if we have a strong bear market, it could go against you as well. I think a good way of knowing when to turn off this strategy is just looking to see if Bitcoin is below the 200-day moving average. And when it is, you know that we're in a bear market and you can just switch this strategy off. And lastly, just remember, for it to be worth it, the returns from the funding payments must outweigh the fees and the slippage that you're actually taking. So if you're trading size, it might not be worth it to trade on some of the lower liquidity dexes due to fees and slippage that you're going to eat. Generally, places like Binance and BitMEX are going to be better for executing strategies like this. Basically, we're talking about holding a token or an NFT and then shorting an equivalent amount. And basically you have zero exposure to that token, but you're also getting an airdrop for holding whatever it is in your wallet. So I'll show you an example here just so you can really just understand what I'm talking about. So the Boba airdrop happened on the 12th of November 2021. And so basically if you held the OMG tokens anywhere like in your wallet or on Coinbase, FTX, Binance, that sort of thing, you would have been given a 1-to-1 ratio of Boba tokens as an airdrop. So there is an opportunity here to actually make money from that without taking any price risk from the OMG token. So what you would do, if I just have a handy little thing here, is that you would buy $1,000 worth of the OMG token and then elsewhere short an equivalent amount of that token, and therefore you have $0 exposure to the OMG token. So basically the price of OMG could go up, down or sideways. It doesn't really matter. the value of your portfolio is going to stay stable, because whatever money that you make going up, you lose money on your short, and whatever money that you make on a short, you lose money on your long. So you just have $0 exposure, but you also have the airdrop to look forward to as well. So why would you actually want to bother doing this? Well, as you can see here, basically the price of the OMG token just massively tanked afterwards. I mean, even if you sold after the snapshot, you probably still lost money. If you held any longer, then you lost, you know, even more. We're talking like 50% in the next month. I mean, like, don't be this guy. Don't be this guy who holds on to something for too long, because everyone knew the airdrop was coming. So everyone bought the OMI's Go tokens, and then they dumped it as soon as the snapshot happened. And if you did this little delta neutral airdrop farming strategy, then you would have walked away with just the airdrops. There have been many examples of this going on where, you know, if you're holding a token in your account, or if you're staking a token, you'll get airdropped more tokens. Now, the best place for this has always been the Cosmos community, because of all of the new chains popping up. How do they distribute their tokens to people? Well, they do it through airdrops. So Shade Protocol, for example, they're airdropping tokens to people who staked Atom, Luna, and Secret. We also have the NTRN airdrop to Atom stakers. We also had the Juno airdrop to Atom stakers as well, which was quite a lot. I think EVM Moss had an airdrop too. So this is one area that you'd want to, you know, definitely take a look at. I think Atom delta neutral airdrop farming is probably a good place to start. In terms of where you can do this in a sort of decentralized fashion, I think DYDX is probably the best place to go. It's a really easy exchange to use. If you've used centralized exchanges, you should be quite familiar with it. And it's probably got the most liquidity out of all perpetual futures dexes out there. Now, this doesn't just apply to having tokens in your wallet or staking a token. This can also work with NFTs as well. So we'll take Bored Ape, for example. They airdropped ApeCoin, which made people thousands of dollars, as you can see here. They also airdropped like other NFTs as well, which eventually became worth quite a bit. Now, NFT Perp wasn't around when the Bored Ape Yacht Club did this airdrop, but you can use this in the future for other big NFTs. So NFT Perp is exactly what it sounds like. So you can go ahead and trade NFT perpetual futures. So you can go long or short, just a bunch of different projects here. So Art Gobblers, Azuki, Milady, Moonbirds, and Bored Ape. So basically you just do what you did in the other situation that I showed you with the OMG tokens. You'd buy Bored Ape and then short the floor amount on NFT Perp. And in that way, you have zero exposure to the floor price of your Bored Ape. Now, I think NFT projects out there like Pudgy Penguins and Miladies are pretty good for this. Right now, NFT Perp isn't actually live. You can only really do paper trading. They do have a beta that is closed. I guess you can DM them or go into the Discord group and try and see if you can get access to that. But this is something that you'll be able to do in the future, and I might revisit it again on my channel once it's sort of open to everyone. Selling your airdrop before you actually receive it. So what I mean by that is that you can use some perpetual futures dexes out there to actually sell your airdrop before you actually receive it. So for example, we can take Pyth. So Pyth, they set up this website where you could check your eligibility for how many Pyth tokens that you were going to receive. And then they set out a date that they were going to release the tokens, which was the 20th of November at 2 p.m. UTC. Now, some perpetual futures dexes out there and some centralized ones actually set up markets where you can trade the Pyth token before it actually comes out. So these are, if you look on Avo, for example, pre-launch tokens. Pyth is no longer here because it's already launched, so they moved it over to the perpetual futures category. So as you can see here on the chart, at 2 p.m. is when it really just started picking up, and then you can see the price go down from there. But prior to that, you could have traded Pyth perpetual futures, I think up to 5 days before the actual launch. So this opened up on the 15th of November. And so this strategy involves just checking out how many tokens that you're eligible for. So not every airdrop will do this. Pi, for example, they did this. I think Jupiter Aggregator will probably do it in the future as well. That's a big Solana airdrop. And I'm sure that Avo will probably have a market for a pre-launch Jupiter token. So as you can see here, you were able to sell your Pi tokens at as high as 43 cents. And you could have locked in any price over here. So typically when an airdrop comes in, like you have an initial wave of sellers, and depending on how fast you are on the mark, depends on what price you're actually going to get if you want to immediately dump your airdrop. Of course, this isn't a perfect strategy because the airdrop could go higher, and then you've missed out on your chance there to make more money. But if you just wanted to lock in whatever price you wanted, you'd basically take, so we'll take Pi for example, let's just say you had 8,000 tokens that you were eligible for. You'd go to Avo and then short 8,000 contracts here. And then so you could have shorted that at 43 cents, and then you would have locked in your selling price at 43 cents. And then as soon as you got your tokens, you could sell them, and then you could close your short as well. So you could do that. That's one strategy. So like I said before, Jupiter, when they eventually airdrop their token, you'll probably be able to trade that. I know there's probably like, ZK Sync, Starknet, I'm sure they'll announce their airdrops at some point as well. I don't know if they'll do the same eligibility thing that they have here, like Pyth does, but if you get that, then you can secure a price for that airdrop before anyone else does by using something like Avo. Additionally, you have Hyperliquid that also set up a pre-market trading for Pyth. So as you can see here, you were able to trade Pyth on the 15th of November, actually slightly earlier than Avo did. Pairs trading is something that a few of you might be familiar with. So it's effectively going long one crypto and going short another. And the reason that we're doing this is that when you combine the different charts of cryptos together, it might actually be easier for a lot of people to actually be charting this. So I know, for example, particularly in crypto and a lot in stocks as well, people like to trade generally with the trend, right? And that's most easily done when we have the trend going up and to the right. If we just look at a basic Bitcoin chart, trading this part here is probably the easiest money you're ever going to make. So from like 2020 to 2021, we had a strong uptrend, and if you're going long at any point during there, it's easy to make money. And so what we're doing here with pair trading, we're pairing two different cryptos up together. So this is the ETH chart versus the Avalanche chart. So what you'd be doing here is going long ETH and then short Avalanche, and that way you can actually take advantage of the upwards momentum of Ethereum against Avalanche. So you could just go independently short Avalanche if you wanted to. However, I think for a lot of people, going naked short is actually something that's quite tough, and particularly when it comes to charting as well. You see lots of different support and resistance lines, and that might throw you off a bit. So if you do ETHUSD / Avalanche USDT here, when you're adding symbols, then that will come up with the ETH Avalanche chart here for you. I mean, I've done this for Ethereum Arbitrum, Ethereum SWI, Ethereum Doge, that sort of thing. And this kind of makes sense, particularly when we're in a bear market, when there isn't much money to be made going long anything in particular. So how it works, let's just say you have $1,000. You would do a $500 ETH long and then a $500 Avalanche short if you wanted to take advantage of this. So for example, say you're a breakout trader. Let's just say like this was the day that you wanted to enter. You'd have this as a line of resistance, and then if we went through that, you would go long here, and these are the gains that you would make in the following days. Now, when it comes to P&L, you don't want to use this measuring stick here, as it won't really give you an accurate representation of how much money you're actually making. If I just go to the slide that I've prepared here, I can show you an example P&L. So this will be our first scenario here. So we've got $1,000 to start off with, and we want to go long ETH and short SWI. We think that SWI is going to take a massive hit because no one's really using it. But we don't want a naked short SWI because we're not super confident on that. And we like the way that the ETH SWI chart looks for right now. So in this scenario, Ethereum moves up 5% and then SWI moves down 10%. So our $500 ETH long turns into a $525 ETH long, and our $500 SWI short turns into $550. So our initial deposit of $1,000 now turns into $1,075, which represents a 7.5% gain. Now we'll have another scenario here, so the opposite happens. ETH moves down 5% and SWI moves up 10%. So your ETH long is now $475 and your SWI short is now $450. And that leaves you with $925 in your position value. And so that's a 7.5% loss. Now I'll throw in a third scenario here. There are 4 different ways that this can go, but it would just be the opposite of what we're seeing here. So ETH moves down 5%, so you're losing money on your ETH long. And then SWI moves down 10%, so you're making money on your SWI short. So in this scenario, your $500 ETH long turns into $475 and your SWI short makes you $50. And then your final balance is only up $25, so that's a 2.5% gain. So when calculating your P&L, you want to take the value of your long and the value of your short, add them together and then compare it to your initial balance, and then there you can easily work out the gain that you have achieved. So to execute this trade and just give you an idea of what it actually looks like, I've gone to RabbitX, and let's just say we're doing an ETH long SWI short because we like the look of the ETH SWI chart. And we'll throw 100 ETH long here. So we press buy, confirm buy, and I quite like RabbitX. It's quick compared to a lot of the other exchanges out there. Obviously, we just see the trade just popped up, and the fees that you actually pay are quite cheap as well. If we go to SWI, we'll throw in $100 short. We'll confirm sell. That's one. There we go. That was quite quick. And so we have an ETH SWI position here. And then when you want to get out of the trade, you can just press close position here and the market close. So right now, I'm losing money if I close this, but it's okay. This is just for purposes of the video. And so one last thing to go over here, I just want to talk about some of the risks present when taking this trade, is that it can move violently against you. If you're shorting something like SWI, for example, that can have a massive rally. And as you can see here, it rallied quite strongly, whereas Ethereum didn't rally as hard, and so you might have lost money on that trade if you were still in it at that point. So if you're shorting the lower market cap coins, they can rally against you quite violently, so be aware of that. And so you probably won't want to use any sort of high amounts of leverage. If you're going anywhere above, like say 2x leverage to execute this trade, then you're asking for trouble. Now, your best candidates are the tokens that have like massive unlocks coming up, or ones that are just not worth much at all. Your base currency here, the one that you want to go long typically, is probably going to be Bitcoin or Ethereum, depending on the DEX that you're on. You might want to use one or the other. So stink bids is a slang term for basically limit orders that are so far below the current market price that they are very unlikely to ever be hit. But in the case that they are, traders can make a lot of money very quickly. Now I'll show you an example of a liquidation cascade that happened on the Kraken exchange in the 22nd of February of 2021. So basically what happened here is that, from my understanding, some whale basically liquidated their life savings in Kraken, and they didn't do it in a clever way. They didn't sell off chunks of it into the market so the order books could absorb all of the selling pressure. No, they sold all of it all at once. And basically what happened is that that caused a liquidation cascade on Kraken. And as we see here, we have Cardano up on the screen. The price of Cardano massively dipped. So if I just show you here, it went down about 85% And this was purely on Kraken, right? This didn't happen on any other exchange. It was abnormal market behavior. And as you can see here, if the wick is present, it means that trading actually happened at that place. So a lot of people think these are fake wicks. Like, no, there was genuine buying and selling, at least at this point here. There might not have been at some of these other points, but as long as it gets down to the bottom here, there was actual buying and selling of Cardano at 15 cents when it had originally been $1 like minutes earlier. But you had some people out there who would have had stink bids in the order books. And say if you had a limit order for like 16 cents on Cardano on Kraken, when it went back up, you made like 580% profit, roughly, depending on where you had your limit order. And so, as you can see, this is an extremely profitable way to start trading, even if you have a little amount of money, right? I'm going to show you another example. So this happened for the Matic perpetual future on DYDX. So as you can see here, there's a massive downwards wick. And that was like a 92%, 95% drop, right? So even if you had a limit order at like, say, 10 cents, that's 629% gain. We'll take a look at Ethereum chart. So this was also on Kraken on the same day. So basically when that whale sold, it caused everyone who's margin trading on Kraken to basically just get liquidated, right? That guy really just wiped out a ton of people. And it not only affected ADA, it affected ETH, BTC, Bitcoin Cash, Ripple, basically everything that is margin tradable on Kraken. So we had like a 60% dip here as well. If you had bids at the bottom, you would have made a lot of money too. We'll take another example here. So this is Binance US. For Bitcoin. So this is like their most liquid pair on Binance US, and still it got hammered. Let's just take a look here. So it went from $62,000 all the way down to $8,000, and people who bought there would have made a ton of money. And these are legit trades, like I said before, right? So if you bought down here, you've actually bought down there. The exchange isn't going to take that money away from you. Like, you've done well there. And here's another example, but this is on Bitstamp, but it goes the opposite way. So instead of having limit buy orders way below the current market price, we have limit sell orders that will basically put in shorts when the price goes to, like, when it spikes up like this, right? So if we take a look here, this is Cardano on Bitstamp. This is the actual movement of Cardano that day, and this was on Bybit. So it did have the wick down, but it didn't have the wick up. So you could take advantage of this on the upside. So this will happen on occasion, but you'll mainly see liquidation cascades, which cause the prices of these crypto assets to go down, as people are usually highly leveraged long in crypto, not leveraged short. So you'll mainly see prices going downwards. So if you wanted to do this, for example, on DYDX, I can just show you quickly how it's done. Let's just imagine we had a limit buy order in for Matic on the perpetual futures pair at like 0.1. So we go to DYDX, change to Matic, and we'll go to limit buy order. Let's do like $200 and then put the limit price at 0.1. So I'm not logged in currently, but this is exactly how it would go, right? And then you just press long here, and that would put the limit order into the order book. And then all you'd have to do then is just wait until that order was hit. So if that order hit, a mere $200 would have turned into like approximately $1,300. So this really shows that you don't need a lot of money to start doing this strategy. So I showed you there where you put a limit buy order in for Matic at 10 cents, but as you can see here, it proceeded to drop like approximately another 40-45% from there. Now, if you were highly leveraged at the time and you had many other positions open, this might have put you at risk of liquidation yourself. And that would have been devastating, because you would have got liquidated all the way down here, and then the price shot all the way back up again. And so that would hurt a lot to see if that happens to you. So what is the best place to start doing stink bids? Well, I've shown you a couple of examples here. So Kraken seems to be a good place. Binance US used to be a good place, but I don't know if you want to go there right now due to the regulatory trouble that they're getting into. DYDX, of course, this hasn't only happened on Matic, it's happened on other places on DYDX, but yeah, this is a good exchange. And then Bitstamp too, because this is one of the more lower liquidity exchanges. If you just want to take a look for yourself, you can go into CoinGecko, click onto Ethereum, Markets, Spot, and then what we want to do here is press the -2% depth. And the -2% depth basically tells you how much money it takes to push the price of Ethereum down by 2%. The more money it takes, the less likely that you actually want to trade on that exchange, because you're not going to be able to get these massive downwards dips in price. On Matic, DYDX, for example, it probably didn't take that much money to send the price of Matic perpetual futures down 95%. Probably only a couple million. And this was probably just a fat finger mistake by some like large whale. Whereas on like Bitfinex, for example, it'd take $22 million. Binance, $13 million. Woo, $9 million. So yeah, as we can see here, Kraken, different Kraken pair. Bitstamp is down here, ETH/USD, of course. Coinbase on the ETH Euro pair. So don't limit yourself to only like the USD pairs, as the more sort of exotic pairs usually have worse -2% depths as well. You can also just use the volume here as well. So that's it. I hope you enjoyed, and make sure to subscribe for more videos like this one.